The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, folks, if you have any questions, it's 877-927-6648. And today is February 4th, as everybody that knows can read the calendar. But it's also the most important astro date of the year on the Bradley model, February 4th. I posted into Tiger TV this morning the S&P index, the cash index, and I also posted in the New York Stock Exchange index, and I also posted in the Russell index, the IWM, and it shows the ABCD patterns. We've gone over the time and price characteristics have all met everything, so we are watching to see the action today, to see what happens. It started relatively bearish, and we'll have to wait and see how much it comes down on the first on this first leg, if it does come down. But it's due. It's way overbought by any stretch of the imagination. I happen to be watching Bloomberg in between the Super Bowl. I don't watch much sports, but I do watch Super Bowl just to see who's there in the ads. And it was very boring, so I would switch back to Bloomberg, and they had some panelists there from Davos. Hardly any of them could speak English, but listening to them talk, it was I must be in the wrong business, because there was only one guy there that really saw anything that I thought was any good, and he said we wouldn't be in business if these Federal Reserve banks across the world, hadn't liquidated or what was the word he used? Anyway, put in so much money into their banks, and then they start a little disagreement. But anyway, that's just philosophy stuff that you can't really go on. I'm going to share with you something a little bit later today. I will show the Bradley model for sure a little bit later, but I do want to show the one of the checklists that Mark Douglas and I worked on years ago on what to look for in trading, and how do you prepare for a trade and stuff like that. So I think that'll be interesting. I'll do that after we finish the first break here. We'll go on to that and take a look at it. But we want to talk about one thing that we talked about last week that I thought was really important in the market, and that is the fact that the Treasury bond market was making a 61% retracement on the long-term daily charts going back to last March. We hit that overnight at 4 in the morning New York time. It hit 142.05. That was the exact number. We rallied a little over $1,500 in the first few hours. That tells you that's probably a pretty good low. It had a 3-drive pattern there. It had a 1.618 expansion, and it had a 1.27 expansion off the low of September. So that could be the thing that gives these bonds a really good chance to rally, and they could rally all the way up to the 149 level, because the world is pretty bearish on those. As I was watching Bloomberg, I was noticing that Bill Gross was telling folks, to get out of bonds and get into equities. I don't know if you know this or not, but bonds are his business. He's got like $1 trillion or more into Treasury bonds, and when he tells people to get out of bonds, into equities, they ought to ask the question why. And remember, some of these people that get on there have self-serving views of what's really happening. Fortunately, I've never been at the size to ever have to worry about that, but you do hear it, quite a bit from these folks that are on there, that they like to, beat their own drum. George Soros is really famous for that. And if you've ever watched the video, The Trader by Paul Tudor Jones, you'll see, how he was using it. He was telling one broker, that he was really, really bearish, and at the same time, he was on the other side of the phone, buying. I believe it was crude oil, whatever it was, it wouldn't make any difference. But that's really how large operators will work, because if they have a big quantity to move. And believe me, the quantities that we have in these markets now are so huge that they really need any help that they can get. Paulson, John Paulson and his fund has had a, when he gets on the wrong side of something and tries to exit, he really gets into, a really big problem. But as I was writing the newsletter this week, I looked at all these charts and I said, my goodness, I haven't seen anything this bearish in a long time. I've been bearish for, a couple of weeks, about 8 days, I guess. But, I really said, you got to come in Sunday night really thinking about, someplace to be short, just looking at these patterns. Whether it'll work or not, remains to be seen. But, just looking at the patterns, they have some really big things there. Yeah, and if it goes higher from here, believe me, and there are always higher targets that you can find, but it could go, another 1 or 2% higher in the market. But overall, looking at the long-term weeklies in the New York Stock Exchange Index, and also in the index for the emerging markets, that thing just barely made, a 786 retracement of the move, and that's not a very good thing either. So the New York Stock Exchange Index, if you go back and look at the last, the last year, actually last year and a half, I will put that one in because that's the one I watch the most. It made a 1.618 expansion on Friday, so we'll see if that is going to be something that will make the market move. Now, many of you have an interest in the Bradley model, so I'm going to that if you're not in the newsletter, or if you don't subscribe to the newsletter, I will put this in so you can take a look at it, and you'll see that we are. We have some time and price things that went a few days longer in the S&P in the Dow Jones than they did, but it basically shows the time between the highs between May and September and the highs between September and January 28th, 6 days ago, and the Dow went up a little bit higher. None of the other indices were able to do it. And remember, the Dow is price-weighted. It's based on the price of the stocks in there. It's not cap-weighted. It's price-weighted. So a stock like IBM, priced at $200 a share, has certainly have greater, weight in the Dow than the other stocks. So we have to watch that. But if you'll notice that the blue line is the inverted Bradley model, and it points down for just about the rest of the year. In fact, it does point down for the rest of the year, but this will be interesting to see if this was going to be doing it. Now, I don't know if it keeps going up from here. In other words, if the market is strong this week and closes higher for the week, I will assume this Bradley date is certainly wrong and will probably go a lot higher. But if it doesn't, then you might want to think about some of these patterns that have formed and some of the bullish enthusiasm that's out there. Like the negativity in the VIX index is actually, quite, it's bearish for people that look at it, but it's bullish as far as a chart because it's down, making new lows and completing, a major butterfly pattern. So you have to pay attention to that if you follow the VIX index. And the VIX index is still good. I mean, people think that it's not going to be good, but frankly, it certainly has a lot of things that make it work over a many year period. The problem is that when the market gets overly exuberant like it does now, the volatility will dry up because prices just keep going up and up, and it's not until prices start to move higher does people begin to believe that the VIX will really move, and then when it really starts to move, that's what you really want to look at. I still remember the show on right before the end of the year when Basil was talking about the VIX reaching 22, and it got to, I believe, 22.5 or 23, where it completed a bearish Gartley pattern. And from that point, the following week, it was the worst week the VIX had ever had. That was one of the the bullish weeks that we had in the stock market. That was the night that the market gapped up on January the 2nd, when most things were closed, and had the big run for the whole month, which made it one of the best Januaries. I think it was the 6th best January in the 175-year history of the Dow Jones. So it's really amazing. It left a big gap there. That gap will be filled quickly, and that comes in at around 1428, I believe, in the S&P. But how quickly, I don't know. That's the $64 question. So that's where we stand with the overall market, and I want to go over a couple of stocks that we're watching because they have a really strong significance because they're in the news all the time, and they have a great deal of press, and we're all aware of what they do and everything. And the one we talked about last week when it was making the high up there around 283, which was Amazon. It's come down about $20 since it completed the butterfly pattern, and it shows the beautiful harmony in this stock. But it also looks exactly like what happened to Apple when Apple was up around the 680 to 705 level, the same type of situation. And so we have to keep in mind that some big stocks, look at Apple. It's gone from 700, to 430, I believe, and I still believe we're going to make the 390, the 394 level because it's only $50 away. One bad day in the market, and Apple could be there right now. And Apple is beginning to have no friends. When it has no friends at all, and you'll probably know that when it gets to that price of under $400 a share, that's when you want to start looking at it because it will complete all kinds of patterns there. We've covered them before, and if it gets there, we will certainly cover it again. We'll just show what the price action for Apple should be. Is that we are looking for about 394 a share in the Apple if it gets down there, but the pattern is at the top is what's important because that's the same type of pattern that you're seeing in the Amazon, and you've also it's already happened in Apple, and then there's one other one that I want to cover, and that is still you can still do this one because it's very very close to the top. It's only down about $8 or $9 from the top, and that's Google. It's the same type of pattern that we had in Apple and that we have in Amazon, and where we stand in Google right now. And Google took out, the September highs by just, 50 cents or so, and then, turned around and started to go down. So you have to watch those stocks and, keep in mind the best way to trade those, stocks that are trading in the hundreds of dollars is to buy an out-of-the-money put. Just go, and look at an April put, something, like two strikes out of the money on something traded at 775. I would easily look at a 650. Got to take a little break. That's a put, not a call. And we have to take a little break here. When we get back, I'm going to share with you, how we set up the trading day as far as psychology and some other stuff. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks, and I posted into Tiger TV. Those of you that are not able to look at it now, it's archived. You could probably go to see it. But it's the daily trading reminders. I've had this, for a long, long time, and I happened to see it. And, Mark Douglas and I worked on this many, many years ago when Mark moved here from Chicago to Tucson in 1997. He since moved to Scottsdale, Arizona, because he's into adult hockey, and they have a whole lot of hockey players up there. Anyway, it's a daily trading reminder, and it's just a checklist of the things to look at. And the ones that are in red, I think, are really, really important to look at. And the first one is red is you must realize that anything can happen, and each moment is unique. And that's true because, the Federal Reserve could come out and say something or do something. So the only thing you can really do is protect yourself, and that leads to number two. It's the amount of risk is the only thing that you can control. If you look at a trader and they look at the risk-reward, equation itself, we never know how much we're going to make. We don't know whether the trade is going to be profitable or not, or even or how much it's going to give us. So the only thing we really can control is the amount of money at risk. So if you'll focus on how much money you have at risk, you'll be far better off than if you're focusing on how much money you can make. I remember the years back at Drexel, the stockbrokers used to call up and say, buy this stock at such and such a price, you're going to make 10 grand or something like that. But no broker ever called him up and said, buy the stock at 6 and get out of it at 5. And that was the guy you probably should have been listening to. The next one is, the Shapiro iteration, and that's the Shapiro iteration was brought out by Steve Shapiro, my friend from many years ago, and helped me write the first book. And basically it means is when you have a really strong trending market, or a market that has a gap in it, that you should wait a bar or two, whether that's a day or 5 minutes or 15 minutes, and make sure that market has stopped going up or down. You don't want to try to catch a falling knife. It's not necessary to do that because there's plenty of opportunities, that happen, off of the things that occurred. And the other thing is the next one is that a trade-off of previous setups that we've looked at before. And those are nothing more than these ABCD patterns and the Gartleys and the butterflies. They repeat over and over again. I mean, you see these on everybody's show. It just really, it's amazing how they repeat. I mean, just look at the stocks of Apple and Google and Amazon. I mean, 3 of the biggest. I mean, they're doing the same thing right now. And then if you look at the NASDAQ, huge divergence there. So who knows? Remember, the primary goal, as a trader, is to try to be as consistent as possible, and always at the same time, avoiding the risk, that you really want to happen. And the other thing is that not having a patience to trade and walk away if your edge is not there, because not having a position on is actually a position. I hope you realize that, because just because you don't have your money in the market, that's still a position. You could be waiting, to get into the market. So those are things that I think you've really got to pay close attention to, and you've got to be able to take money off the table, because this is a business of making money. It's not a business of being right or wrong. And that's the whole premise of why we do this. The reasons to trade. I've talked many hours about this with Mark, and people like to trade just because of sheer enjoyment of the work and the dedication necessary and the accomplishment of trading, because so many people can't do it, and it does take time to do it. But the best thing is the freedom to choose the quality of life that you like. In other words, you're working for yourself. You're the one that signs the front of the check. You don't sign the backs of the check for anyone. That's the whole thing. And the last one, I think, it's the challenge of the personal discipline that it really requires to be a trader. And that's why, I tell people it takes several years usually to become a professional trader. You're going to make a lot of mistakes along the way, but those people that stick with it are going to be successful at it. I've seen very few people not make it that stick with it. Sometimes it takes them a little bit longer than other people, but they can still do it. Stop and think, our business offers equal incomes to any doctor or dentist or attorney that's out there, and yet there are no colleges that really teach us. They might teach a course or two. I give a lecture here at the University of Arizona usually every year that's 1 credit, and that's just like a 3-hour or 5-hour class. I mean, you can't teach anyone in a short period of time. Even in 1 semester or 2 semesters, you can't get enough information. We go to the school of hard knocks, folks, and the hardest teacher in the world is, the mistakes that we make, but you have to learn to do it. There's an old Chinese adage, the smart man learns from his mistakes, but the wise man learns from the mistakes of others. 877-927-6648.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the market, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks. And we want to take a look at mainly what I'm going to do first is to work with the I want to show you the difference between the consumer staples chart and the S&P. Consumer staples, are the high what do you call it? The high end things for what people buy. Staples, stuff we use all the time. Anyway, you'll notice that even though the S&P index has gone, a lot higher. The staples has made lower highs. That means that people are not really, buying nearly as much as you would think they would be buying if they were looking at it. And there's also another chart that shows the S&P 500 along with the consumer confidence numbers that came out just recently. And you'll notice that the consumer confidence has been dropping off, even though the stock market's been going up, and the S&P has been going higher, which shows a very, very large divergence. And that in itself is almost like an outlier event. So, that's one of the things that, you want to keep in mind that we're seeing in some of these different divergences across the market. But the main one, I think, is to realize that, and we talked about this before, is the price of copper, is used in just about so many things, anything electronic, telephones or any appliances and computers and all that other stuff. And the price of copper has not been going up. It's had lower tops along the way. We did have a rally up to about 380 a pound, but that was just at the 786 retracement, and it sold off too. But given the bullishness in the stock market, you would think that copper would have been able to to go a lot higher at that particular time, but so far that has not been the case. That could change, of course, at any time, but right now that's what it's looking at. Shucks, I lost something. I had give me a second to find it. Oh dear. It's tough when you're doing two things at once here. Oh, I wanted to move to the currencies here for a bit because we've been talking quite a bit about the euro and the dollar has held that 79 level that we talked about all last week. It made the double bottom, but the dollar versus the yen made a higher high. We got up to just about the 94 level last night, and before it started to sell off a little bit for a correction. And we will get a correction here because this has had so many weeks in a row of an up move, and the whole world is now bullish. This is the winding down of the carry trade, and that could take a long time. But there'll be an ABCD correction coming here in a few weeks. It'll take a few weeks because we were up, the equivalent of about 20 weeks, which we came down 20 weeks from February through October. February through 2011, we came down 20 weeks during that time when we made our bottom down at that 79 level. The first time we came down about 18 weeks when we made the bottom during the low at 75. That's when we first started to really get bullish. That was Tom's, really beating that bandwagon trade. He really liked the Japanese yen at 75, and that's certainly been the way to go. But we will get a pretty good ABCD correction in this over a period of the next weeks. But you've got to wait in order to to really get to it. Next one I want to talk about is the euro, because we came very close to making the 138 level last week. We got to 137 and change. Whether we make that final one or not, we have to wait and see. It all depends upon the dollar, because the dollar is held up at that 79 level so very well that we have to be able to say that this is the one that we really want to look at and make sure that it's going to hold that level. The other one that I think is important in the Forex is the British pound. We've now touched the 61% retracement at 157. We've held that for 4 days in a row now. We're still only 30, 40 pips above it, and as long as we stay above that 150, 680 or so in the British pound, it looks like it still has a chance, to have, some type of a pretty good rally. So those are the things in the foreign currency. Now, you hear a lot about, these things are supposed to be related to, some type of a currency war. That I don't know. But the next chart that I want to put in here is the U.S. dollar index chart. And if you remember that 53% of this is the euro, and the Japanese yen has a big percentage in this also. And you can see the double bottom support. In fact, there's triple bottom support at that 79 level that is held very tightly. Now, if we get below 79 in the dollar index, that's going to signal that the euro is going a lot higher, the yen's going to go a lot higher, and we're probably going to be looking at something in around going back to test that 75 level one more time, or at least the 77 level in the U.S. dollar index. But until that happens, it still looks very, very bullish. There's nothing negative about this when you look at it from that point of view. There's just nothing that you can do to say that it's negative. I mean, it's just holding up extremely well. So we'll watch that. Now we did have I don't want to get too much of commodities here because that's the Thursday show, but we had some really nice Gartleys form in the crude oil complex last week on Friday when the crude oil hit 98. The gasoline futures made a big ABCD, so we should be getting a break in gasoline futures, buying it at the pump and stuff. So that will be interesting to see. And we also wanted to talk a little bit about the oh, shucks, I missed that one too. Boy, when you're trying to do a radio show and click and hit at the same time, it sometimes gets really challenging, especially when you're an Italian. All right, I'm going to bring up the gold market here because this gold market has had some really nice moves and has held the moves extremely well all along. We had the really nice test back at the on the 28th. It held the level extremely well at the 1651 level, and we came down and we made a beautiful test last night at the 61% retracement at the 1663 level. And so, and all we've done now is rallied up to the 786. But that's a $1,400 move, and gold held there for 4 hours, and silver actually held up extremely well too. So gold is still it still has the potential for much higher prices. We've had higher bottoms. If you remember on the daily chart on gold when we were looking at this, back in June, this thing had all kinds of bottoms that were really higher and higher, and that's what we were looking for. And we have a very strong uptrending channel now since we held the low at 1627 in the gold. As long as that holds, we still like gold from the long side, and that's the basis of what we're looking at is if these support levels hold, and that's so far that's what they're doing. And when they go down there and hold for 3 or 4 hours, that's telling you that somebody's got orders that are sitting there that are absorbing it every time it goes down. There's an order for 50 or 20 or 100 or 300 or 500, and that's the reason why you watch these numbers. And when they fail and go to another set of numbers, then you've got a problem. That's what you're trying to do as a trader, is to prevent the problems from occurring. So if you watch the support and resistance, then you're going to be far better off than if you don't, watch the support and resistance. That's just, of course, my own personal opinion, but it's based on a whole lot of experience over many, many years. Now we're talking about crude oil, and since it's a big component of everything that we do in our lives, and everybody, that it's just like a hidden tax when we don't pay attention to it. But we've just completed a bearish Gartley pattern up at this 98 level. It's now down about $1,600 from the high that we were talking about on the commodity show last Thursday. And it looks like, we're going to be potential. We could get down to the $89 or $87 per barrel level. But on the other side of the coin is if we break above the $99 per barrel level, that sets up an easy move. It was a big ABCD move that could take you to 108 a barrel without too much trouble. But right now the pattern is working the way it should be working, and we will see if it continues to do this. But this is the way it's setting up right now, and has done exactly what we expected us to do. If you have any questions, it's 877-927-6648. Someone had a question, about the Bradley model. How is it constructed? It's basically based on 10 cycles. They range from the lunar cycle of 28 days all the way out to the Pluto cycle, which is, no one can count that high. But it's how these planets come together, and when they all line up in a certain way, it has a high percentage of things happening more than others. That's all it is. It's just a probability, but it is construed of 10 different cycles, and they're weighted a little bit differently because they're weighted on whether the cycle is supposed to be either bullish or bearish, and that goes back to the work that was done by some Babylonians 3500 BC. Andrew Lowe covered this in his book, The Evolution of Technical Analysis, and he said that the astrologers were the first, technicians, and they would mark, these stone tablets on where the price of wheat was going to go by using the planet Mercury. And Mercury has a very positive influence, and Venus has a positive influence, and then also it depends on whether it's a conjunction at 0 degrees or an opposition where it's 180 degrees. Like 0 degrees means you're at a new moon, and 180 degrees you're at a full moon. Pythagoras, figured this out, in 693 BC. He knew that the Earth was round just by looking at the full moons and the new moons. He also knew that the distance between the Earth and the moon was 250,000 miles just by doing the calculations using his Pythagorean theorem of ABC. So that's just the thing that you want to keep in mind of what you're looking at. Okay, now the Bradley model, percentage-wise, it works about 70% of the time. The inversions that occur, when they occur, unfortunately, they usually happen during the time of pattern recognition. So what you have to do is to try to, add them both together to make sure that you're, trying to do it the right way, and quantify your risk, and realize when you're wrong, and move on, to the next thing, because that's all you really can do. It's been really a good servant over the years, but sometimes it'll stay, it'll confuse you for more time than you want. But we're at February 4th now. This is a big day. This is a huge day. This is the kind of day that you want to watch because it's it's a big day on the chart. And if it does work, it's going to tell you that you're going to be down for quite some time, and you can watch your portfolios and stuff the way you'd like to, or whatever, and it'll keep you from losing a lot of money, because you don't want to be in a bear market where you don't have a lot of things going for you at that time, and that's the main thing that you want to keep from doing. We had a lot of divergences in these markets over the past weeks and stuff, but I think one of the most important that we've had is the fact that we had this divergence in the NASDAQ, where I'm going to put this one ratio in, and then we will I'll post it into Tiger TV. But we've gone up to the 618 retracement again, and we've been there for 1, 2, 3, 4. We've been there for 5 weeks, folks. The S&P and Dow went higher for 5 weeks, and the NASDAQ could not. And now what we've done is we formed a very significant head and shoulders pattern, where you have the left shoulder going back to last March, and then the head back in September, and then the shoulder where we are now. And we're having a lot of time symmetry between these highs, and that's another thing that you might want to keep in mind. And remember, the NASDAQ was the thing that started this whole thing up. That was the strongest. That was the thing that made it all come together. And, the Apple was, a great deal of that, but still, it's stalling now, and it's not really doing nearly as well as you would, like to see it do. So you've got to, keep that in mind, that there's a possibility that this is, something that is, really, really important. Now, I wanted to bring the chart of someone asked a question about the copper. What is the, the relationship between these things? All I can tell you is copper has not made a higher high from September, and yet on the, everything else has gone, through the roof. And so it just completed an ABCD pattern that we talked about on the commodity show this past week, and it's just at that level that looks like it's going to have trouble. Now, there's a chart that I need to show you, that because a lot of you folks don't follow Forex, but it's a very important chart on a longer term basis, and that is the chart of. We got to take a little break here. Anyway, it's the chart of the Australian dollar. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, I'm going to finish up the show here with the Australian dollar. Australian dollar is a very big economy, and it really likes to see the market move quite a bit. You know, it trades very, very actively, of course. But I posted in the chart to show you that the fact that this thing has stopped, the Australian dollar has stopped at the 786 retracement up at the level of 106. It's now trading at 104.23. It stopped at that 106 level 4 times. Now, the reason why I bring this up to you is, you know, their economy is certainly different than ours because it's so far away and different people and everything, but there's a great deal of correlation between them sometimes. And what I'm going to do on the second chart, if you get a chance to look into Tiger TV, it shows the Australian dollar versus the S&P 500. And you can see the tremendous divergence that we've had since January the 7th. Well, you know, what you want to do is to see if this divergence has helped in the past. And if you went back to, you know, last February, you'll notice that there was a double top in the Australian dollar, and it started down. And shortly thereafter, the S&P 500 started down and went down into all the way into June. The same thing occurred in September of this year. You know, the S&P backed off into that November 15th low that, you know, was the solar eclipse and new moon. But lately, there's been a tremendous divergence in the Australian dollar versus the S&P index. So you want to keep that in mind as you know, one of the things that one of the things that we're looking at. the things that I'm watching right now, the real key things that mean a lot to me are the dollar index at the 79 level. That is just really etched in stone. Also, the Treasury bonds at 142.05. I believe that's etched in stone. And what I mean by etched in stone, if we go below those points, there's going to be big moves, to the other side of it. But until that happens, they're still heading to the upside. The other thing is our gold market. It still looks bullish. Ever since 1351, it looked bullish. It looked bullish last Thursday at the 1360 level when it made the first 1660 level when it made the first 61% retracement. So those are still in play. They look pretty good to the upside. I don't do much in silver, but it has held up extremely well. As a matter of fact, it's been backing off less than the gold has, and so that's actually a positive sign because the liquidity on the silver is 1/6 of what it is, in the gold market. So, keep those factors in mind. Someone asked the question, when will you know if the stock market is going to go down, big time? I think you have to see, several days. If you see a day, we got down about 120 in the Dow at one time. If you see a day of 200 or 300 points down in the Dow Jones in any one day, then I feel very confident that has, that's put a very strong nail in the proverbial coffin. But that has to happen. But you could see a few quiet down days and maybe a retest of the high. I'm not really sure. All I know is this day is very, very important on a cyclical basis. It's got importance like we haven't seen since March of 2009 and also July of 2010. So that's something to really keep in mind. We have a holiday next Monday. It's President's Day, and I believe the markets are closed that day. So we've only got 2 more shows this week before we come into that. So we'll see if that's on the 18th. It's not on the 11th. So that'll be our last holiday for quite some time. That's it, folks. Live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.